Frank DiMora here with the news connecting Bible prophecy and current events. On October the 1st, 2021, at my prophecy site, which you see here, BibleProphecyMan.com, I put up a video along with some news about the crisis of the shipping and how it's going to affect people. Well, there's other news about this that came out only 4 days later that I want to give you this news in hope that you'll prepare for what is coming because of this crisis in shipping. It's a global problem, not just in the United States. Now, on today's post, which is the 5th of October, I replaced the video that I made about the problem with the shipping. And I'm going to have it on my October the 5th post, again, in case you did miss that video. But I'm going to add some other news with it that I want to give to you right now because it's super important to understand what's about to happen and how it's going to affect you. And before I get into the news, if you're new and you just found my website, please take advantage of my book. You can see it. You can get it today for free by going over to the website and click the link down here and you'll be able to access the book, The Last Chronicles of Planet Earth. It has all the information you're going to need to show you that we're in the last generation, connecting the dots between the warnings of Jesus compared to what we're seeing in the news now almost on a daily basis. But in the news today, which I'm referring to, you'll see I put up a portion of an article that came out. The headline to that report: International Shipping Group issues red alert letter warning of imminent global supply chain collapse. Widespread famine, power grid failures, and economic ruin are right around the corner. So I'm not going to take the time to read this entire article. I'm just presenting it to you. I'm asking you to take your part in this very important issue. Go over to my site, click the link. You'll see the link at the bottom right here. Just click the link and read that article. It's really, really important. But there's another article that came out that I want to play this article for you because it has a connection to what I'm talking about with the shipping problem. Now, besides the United States, Asia and Europe, they're having major problems which will affect the United States. Their article that came out, Power Crisis Deepens in Asia and Europe, what it means to shipping. Listen to this article.
Power crisis deepens in Asia and Europe, what it means to shipping. As some Chinese factories go dark, more delays for container imports but bullish sign for coal, LNG and oil shipping. There's panic buying of gasoline in the UK. Natural gas prices in Europe and Asia are skyrocketing. Protests are breaking out across Europe due to spiking electricity bills. India and China are short of coal for utilities. Power is being rationed to factories in multiple Chinese provinces, and winter is coming. First came the COVID-induced global supply chain crisis for container shipping. Now comes a power crunch across Asia and Europe. Energy commodity stockpiles, just like U.S. retail inventories, did not build back up fast enough to contend with post-lockdown demand. How could the power crunch affect ocean shipping? For U.S. importers of Asian containerized goods, it's a negative, another crimp in the supply chain. For commodity shipping, dry bulk, liquefied natural gas, LNG, and possibly oil tankers, it's a recipe for higher rates. Container shipping. According to Bloomberg, power use is now being curbed by tight supply and emissions restrictions in the Chinese provinces of Jiangsu, Zhejiang, and Guangdong. Bloomberg quoted Nomura analyst Ting Liu as stating, "The power curves will ripple through and impact global markets. Very soon the global markets will feel the pinch of a shortage of supply from textiles and toys to machine parts." Nikkei reported that an affiliate of Foxconn, the world's biggest iPhone assembler and a key supplier of Apple and Tesla, halted production at its facility in Kunshan in Jiangsu province on Sunday due to lack of electricity supply. Another Apple supplier, Unimicron Technologies, also halted production in Kunshan on Sunday, said Nikkei, citing regulatory filings. The New York Times reported on power outages in the heart of China's southern manufacturing belt, in Guangdong. Factories in the city of Dongguan have not had electricity since last Wednesday. The Times interviewed a general manager of a Dongguan factory that produces leather shoes for the U.S. market who has kept his operation running with a diesel generator and who said that power outages began this summer. Stoppages of Chinese factories would further delay deliveries of U.S. imports, which have already been waylaid by extreme congestion at ports in Southern California and, more recently, ports in China. Dry bulk shipping. Whether it was coal or natural gas or oil, there was very low capital available for companies to continue to reinvest in production for several years heading into the pandemic, explained Clarkson's Plato Securities analyst Omar Nokta in an interview with American Shipper on Monday. We built up a big stockpile in the first few months of the pandemic, and we went right through it as soon as lockdowns abated, but capital hasn't been redeployed. There has really been a true lack of investment. In particular, thermal coal used for power generation, faces steep restrictions in access to capital for environmental reasons. Thermal coal supplies in China and India have dwindled as post-lockdown electricity consumption has eaten into inventories. India's stockpiles are at a 4-year low. China's supplies are further limited by environmental restrictions on domestic mines and a ban on Australian imports. The Newcastle benchmark thermal coal price was up to $205 per ton on Monday. This is good news for dry bulk vessels in the Capesize and Panamax classes, said Nokta. Capesizes have a capacity of around 180,000 deadweight tons, or DWT, and Panamax's 65,000 to 90,000 DWT. Capesize's spot rose to $69,000 per day on Tuesday, with Panamax spot rates rising to $36,200 per day, according to Clarkson's. People expected some bounce back in demand for thermal coal in 2021, but the surge in demand was not at all anticipated, said Nokta. That resurgence is keeping Panamaxes and Capes very busy when they can't count on the cargoes they normally would, grain for Panamaxes and iron ore for Capes. Grain has been consistent throughout the year and now the Panamaxes have this added thermal coal element. Capes have faced a somewhat inconsistent Chinese steel market, production plunged in August, but it hasn't mattered because of all of these thermal coal cargoes they've been able to carry. Capesize rates have risen over the past week despite escalating concern over the fate of Chinese property developer Evergrande and the Chinese property market in general. The real estate story is still a question, and the regulators are tempering steel production to limit pollution, said Nokta. But we could have a situation where iron ore demand dips and there's a handoff to thermal coal, and when thermal coal demand diminishes after the winter season, the iron ore market comes back to life. So you may not even feel it. LNG shipping. The shortfall of natural gas in Europe and Asia is clearly evident in historically high natural gas spot prices. The Asia benchmark, the Japan-Korea marker JKM, had risen to $27.50 per million British thermal units, MMBTU, on Friday, nearly double the August price. The two European benchmarks, TTF Netherlands and the National Balancing Point, NBP, have risen in lockstep with the JKM to $26.51 and $26.23 per MMBTU, respectively. TTF and NBP are at all-time highs. The U.S. Henry Hub price has risen, but to far below these levels at $5.51. Last winter, amid a huge spread between natural gas prices, LNG shipping spot prices spiked to $200,000 or more per day. One spot voyage reached $350,000 per day. But currently, rates for tri-fuel diesel engine LNG carriers are $51,000 per day, just below the 5-year average for this time of year, according to Clarkson's. Asked why LNG spot shipping rates are not surging given extremely high commodity prices in Asia and Europe, and a large spread with U.S. pricing, Nokta cited two reasons. First, he said that the big spikes in spot shipping rates happen when there is a big spread between the European and Asian commodity prices, and there are aggressive re-exports from Europe to Asia by traders. Right now, the JKM is at parity with Europe, so there isn't as much cross-hemispheric trade. Second, when spot rates spiked last winter, cargo interests took LNG ships on long-term charter to protect against future high spot rates. Most of the charterers covered their requirements and spot activity has really dwindled in the past 3 months. So when you look at spot rates, they may tell you things aren't on fire, but there's actually a lot of cargo movement. Even so, spot LNG shipping rates could see a jump this winter if the spread between European prices and the JKM widens and more companies with chartered ships relet them into the spot market to profit from higher rates. Tanker shipping. Product and crude tanker rates remain below break-even, but some analysts and brokers believe power shortage in Asia and Europe could help jumpstart these beleaguered shipping markets as well. As with other commodities, oil stockpiles are low. Evercore IC analyst John Chappell said Monday that OECD refined product inventories are now lower than pre-COVID levels and are well below 5-year averages. However, at a certain point, inventories approach a level where there is no longer much slack in the system. Nokta noted that in past commodity cycles crude oil led the charge, and this time it seems all the other commodities rose and crude is bringing up the rear. But all the same fundamental factors and drivers are there for crude as with other commodities. In light of extremely high natural gas prices, Goldman Sachs recently estimated that Asia and Europe could use up to 900,000 barrels per day more oil for power generation as a substitute for natural gas. According to Gibson Brokers, this would depend on a cold winter and would also likely be focused east of Suez, where oil-based fuels have greater potential to form part of the power generation market. Gibson said, high sulfur fuel oil, HSFO, is expected to be the primary beneficiary in countries including Pakistan and Bangladesh, as well as some Middle Eastern players, have already been more active in the spot HSFO market as LNG prices began to rise. Higher HSFO prices could potentially increase refining run rates, supporting crude demand, added Gibson. Nokta pointed to this upside as well. When we think about oil consumption, that's been improving purely on mobility. Gasoline refining margins have strengthened as more people have gotten vaccinated, he said. But you could have this other element with fuel oil. Refiners could ratchet up production, which would mean you're bringing higher amounts of crude into the refining system and producing more distillates and fuel oil. It's a nice setup for tankers, affirmed Nokta. You've got improving oil consumption, shrinking inventories, OPEC promising to boost output, and now throw in an energy crisis as we go into winter. Related articles. If coal is dead, then why are ships so full of it? Container ships now piling up at anchorages off China's ports. Record shattered, 73 container ships stuck waiting off California. Shipping stocks hammered as China fears intensify. China bulker pileup dwarfs California container ship gridlock. How China became the big winner of the COVID era.
When you go over to my website, you'll see 2 other articles of importance that deals with the same topic that I'm talking about today. One of the articles, the headline, "Just Get Me a Box, Inside the Brutal Reality of Supply Chain Hell." And this article is very, very good because it explains the difficulty of just being able to get a container to get the product over here in the United States. The other article, "No End in Sight for the COVID-led global supply chain disruption." Again, this is from Forbes, and you won't even have to read the article. All you have to do is, when you go over to the article, just click the link and the article will be read to you. But it deals with the massive amounts of containers that are not moving. And when they're not moving, that means that the supply chain is backed up, which means empty shelves, more empty shelves than we're seeing right now. This is just the beginning. And just the synapse of it, it says, a chain is only as strong as its weakest link. So the saying goes, when it comes to the current state of the global supply chain, weakness is everywhere. Massive dislocations are present in the container market, shipping routes, ports, air cargo, trucking lanes, railways, and even warehouses. The result has created shortages of key manufacturing components, order backlogs, delivery delays, and a spike in transportation cost and consumer prices. Unless the situation is resolved soon, the consequences for the global economy may be dire. Now, the reason why I am posting this information about the global chain disruption is because Jesus warning about famines in the last days. And if you can't get food to the market, you're going to end up with famine. At the same time that all these other signs that Jesus talked about are in the news as well. So please take time and to read this information or to listen to this information because it will affect you. Please subscribe to my channel and let's watch these last days events unfold. Let's be wise and be on guard as we know Jesus' second coming isn't that far away.